G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Wargent Property Buyers. I'm here with Chris Bates from the Alcove Mortgage Group. G'day, Chris. How's your week been?
Oh, it's been good, Pete. Just really settling back in after the break. Poor kid's having a tough time getting back into kindy. One's completely over kindy, needs to get to school in a couple of months. I'm pretty excited for that. But yeah, we've had some cracking weather in Sydney. It's hard not to have a sensational weekend like we just had, even though I had to go to so many birthday parties. But yeah, got some beach time in, got some time at some friends' houses. Yeah, it was a good weekend. What's news with you, mate?
Good to hear. Been playing a bit of golf this week, actually, which has been good. And if you're watching on the YouTube or on the video, I've got the Lions merch on. I think we're going to need all the help we can get this weekend. Actually, by the time this goes to air, the prelim finals in the AFL will be all over, I think, actually, or at least 7 a.m. Sunday. Yeah, at least heading on that way. So, so probably a bit dated, actually, by the time this goes out. But, we've had so many injuries in recent weeks and suspensions that it could be one step too far, but you never know. So all will be revealed on the weekend. So, and back in property world, gosh, yeah, we're really finding it tough going out there. I know we've been saying this for a couple of weeks now, but, we're just seeing, the market has just moved in the last couple of weeks, particularly at the sort of entry-level price point. Our guys are saying, we've seen prices move 10% in a lot of cases in just a couple of weeks. We went to one open home, a suburb called Goodna in Brisbane. There was 40 offers on the property. So that's the kind of market we're getting into. Not everywhere and not right across the market, but I think that's anywhere from sort of 700k upwards. It's moving, and it's moving fast at the moment. Just not enough stock, too many buyers, and we've got a first time buyer's deposit guarantee coming, and I think that's what's triggered everyone into action. So yeah, it's a tough buying environment, and if you're trying to do it at the moment, our heart goes out to you because it's pretty tough.
Yeah, it's interesting when you think about rate expectations. I think that's been a big driver since these 3 rate cuts, that it's given buyers a lot of confidence, right? And sellers are always slow to enter the market. We talk about that a lot. It's sort of that lag in listings. Often people sell their properties when they can find other properties they want to buy. There's a lot of people in the market, and a lot of people can't find properties to buy, so they don't sell. And so there's this sort of constant Mexican standoff. I'm not sure if that's politically correct to say that, but it's a kind of a gridlock, you'd probably call it, in the property market, where one can't move till the other can't move. So rate expectations have sort of come back a bit, Pete, right? Like, I think and that's not a bad thing. Obviously it's a bad thing if you've got a mortgage and you're in a bit of debt. Like, every rate cut is definitely helpful. But it's a time when there's just a lot of demand. So I don't think, that's really affecting things. And if that goes the other way, it's only going to create more demand, But we're expecting probably low 3s, 3.2 next year versus maybe a 2.9 that we maybe had pretty stable for the last probably 6 months. And so, rate expectations are a little bit less, and maybe it's not as going to be as in the bag as people expect. And maybe there's only 1 or 2 more rather than, say, 3 or 4. And, we've had some huge months. You probably, if you've been listening to this podcast, we're doing this 18 months now, Pete, but, we're not always hyping it up. Someone new to the show will be thinking, oh, these guys just talking the market up. But it's not the case. We just look at, our client behavior, what I see with not just new inquiry, old clients coming back, how fast they get doc, returns back. And, we started to see that pick up in May. Absolutely, it took off in August. And if we just look at even this last couple of weeks, the time when a client comes and when we request docs and when it comes back, you're talking like hours, not days. Buyers are very urgent, and it makes sense. You're middle of September. There's only really 6, 7, 8 weeks till new listings will die. And so you've got to get in the market now if you want to buy before Christmas, really.
I think you're right. Just on the market cycle point, because I think I often have a look at what's happening in the UK because I've got investments over there, but also I'm always sort of tracking what's happening in Canada and New Zealand, because I think more so than a lot of other countries, we have a lot in common, I suppose, with those countries in terms of economy, high rates of immigration. And I think if you look at particularly Canada now and also NZ, prices in real terms for the housing market are both well off the high. So I think it can often feel like when you're in the midst of an upcycle for the housing market, it feels like it's never going to end. But the experience has always been that that's not the case. I think if you read a lot of the rhetoric at the moment in Australia, there's a lot of criticism of the big Australia sort of migration policies, and in I suppose just in the past week or two, a lot of analysis of what sort of percentage of immigration is highly skilled. And look, there's lots of different takes out there, but if you include sort of family members and all that kind of thing, it's not always as high a share of the immigration as you might think. And there's a lot of people saying we need to cut back, and then there's the counter arguments because we need people to build homes, and then people are saying we're never going to build enough homes, as we talked about last week. But I'd say, well, it sort of feels like that at this stage in the cycle. Actually, I would think that even though at the moment we're in a massive shortage of housing, at some point the economy cools, interest rates are lower, and then housing construction tees off, and then at some point we get a glut. That's just the way the cycles go. It's just at the moment we're in the thick of the shortage, and it feels like it will never end. So yeah, you're right. At the moment, it feels like we're talking about FOMO and people piling in and stuff like that. But it won't always be that way, and that's why we always emphasize when you're looking to buy a property, you must always try and buy something. What was the old Buffett quote about if you're not prepared to hold something for 10 years, you shouldn't own it for 10 minutes? Well, it's kind of the same, really, and probably maybe even more so in real estate, because it's much more difficult to sort of buy and sell quickly when it comes to buying an asset. So you want to buy something you're really happy to stick with, if needs be, because selling conditions won't always be as friendly as they are right now.
Yeah, and I think I've been slated a couple of times with talking about Chris Minns, and and a lot of that comes down to people's frustrations depending on the assets they own or the challenges they're currently having, whether it's buying or renting, or they might be affected by it because they've got investment properties, etc. And so there's a lot of self-interest in there into that debate, but I think we've got to have a city-wide view and go, well, and a countrywide view. If we are going to have some type of migration and increasing our population of a city, we need to do this in a way that's way smarter than the way that we used to do it. Turning farms to houses, and building high density, often in just a couple of postcodes and no one else really sort of helping out. And I'm constantly tracking that. I mean, there's a lot of change in New South Wales over the last few years. Even this week, there's some changes with Parramatta Road and some, rezoning happening there. That makes a lot of sense. You're turning old car yards to basically apartments, and it's a great thoroughfare into the city. I think that's a good plan. I mean, even this morning, I wouldn't say I'm as across the Victorian story as much, but if you look in the AFR today, there's the state government's going to start to copy New South Wales and override the councils. And so if you can't get your project approved by the local council, you can submit it to the state government, and the state government can approve it. So they're really trying to flip the scale back. And Melbourne in Victoria has always been a pro-development place, but you can see they're really trying to encourage supply. And I think that's the solution. No matter where we build it, as long as we're increasing the number of dwellings, I think that's what matters. And whether we're building for the high end or the middle end or the bottom end, I think we just need to get building, and that's the solution, to be honest. And if you can build or also create affordable key worker housing, I think it's a good result. And our city just has to change. But that Victorian story, I think let's do a bit of a deep dive over that, Pete, because I'm really keen to understand what they're doing down there.
Well, that's the market cycle in action, isn't it? I think if you went back to Brisbane maybe a decade ago, it was pretty difficult to get certain projects through. And then there was a huge push to start allowing more, particularly medium density projects through planning, and the things got a bit lax or a bit easier to get through planning with the council. And then we got a huge boom in construction, and then things tightened up again. There was a big push back against townhouses and townhomes in some of the lower density suburbs. And at the moment, the push is all in favour of getting more supply through in Sydney and Melbourne, because we've got a big shortage. So although I'm actually heading over to Melbourne very soon for the AFL Grand Final, but I'm less sort of close to what's going on there in terms of planning. We might have to get somebody on the show who sort of knows a bit more of the detail around it. But yeah, generally Melbourne has been more amenable to development in recent times, and you can sort of see that across the city. And yeah, I guess in some areas there's a bit of an overbuild a decade ago. So yeah, it's definitely the phase we're in at the moment. So let's take a look at our big three property news stories of the week then. So every Sunday at 7 a.m, Chris and I will go through the top three property news stories of the week, and then stick around because at the end we do a listener Q&A, and we've got some of your listener questions to cover off as well. So first story this week from the Australian Financial Review: grandparents driving up luxury unit prices in their favourite suburbs. So just having a read through this a sort of piece of analysis. So the unit market is a bit two speed by the looks of it. I think unit prices in some parts of the country, particularly Brisbane and Perth and Adelaide, have really teed off in the last 5 years or so, but that hasn't been the case in Sydney and Melbourne generally, so at the sort of macro level. But this article is saying in certain pockets, prices have really shot up. Now, I think you can always sort of add a caveat when you get suburb level data, because it's often sort of based on relatively small numbers of transactions, and the numbers can be up and down a bit. But with that point to one side, here's what they found. Suburbs like Ashburton in Victoria, unit prices up 5.9% in 3 months. So that's located near to Malvern, or in Australia you might say Malvern, Burwood, and particularly Chadstone, or Chadstone with the shopping. And in New South Wales, Rozelle in Sydney, unit prices up 7.4% in 3 months. So you're sort of in that pocket there close to Balmain, which is always really popular. And I suppose the general thesis here is sort of grandparents moving out of their sort of big suburban family homes, downsizing, but wanting to stay pretty local to things like family, but also sort of local amenities, the shops and the schools and that kind of thing. So I guess that kind of makes sense. I think sort of the unit market more broadly has certainly underperformed, but there's certain areas where things have apparently started to shift. So I think this is, I guess it's something we've sort of talked about on the podcast over the years, Chris, and on other forums as well, is that the unit market, I mean, it sort of gets disaggregated to houses and then attached dwellings, but actually even within that, you've got the a lot of new high-rise stock and new apartments that have really underperformed badly in the past decade. And then there's certain areas where you just get an undersupply, but more or less continual undersupply, particularly in places like Sydney, where sort of a good boutique unit, certainly in some of the more affluent areas, have done really well. So I suppose it's a question of choosing carefully. And these suburbs kind of fit into that criteria, I suppose. There's restrictions on supply. They're in good locations where people really want to live. They don't want to move too far away. And that's kind of pressurized prices in some of those sort of key pockets.
Yeah, I think you got to think about the owner of these apartments. A lot of them are probably quite smart investors, betting on, scarcer units, older blocks, smaller blocks, in affluent sort of areas with tight supply. And, as more and more people, particularly this is in Sydney, I would say. Melbourne's had a bit of a different challenge with the units. And even Brisbane probably had a bit of a tough time investing in apartments up there if you went down that route versus houses. I remember talking to a client many years ago, and had like 10, 15 units. And I was like, why aren't you in the housing market? And, it's been a huge opportunity for that client when I reflect on that conversation. And, but yeah, I mean, they have bounced up a lot in the last few years. I think really just like the new housing estates on the fringes of our capital cities, it doesn't take a rocket scientist to figure out that you're not buying a quality asset. You're buying something that was a farm that's been turned into a 300-400 square meter block. And most of your money's going into a pretty affordable build that's going to age really fast, and it's not scarce at all, right? So you don't have to understand that that's not really a quality asset, right? But ultimately, there've been all rising tides lift all shifts, and what's been happening has been a real restrictive, lack of new developments and house release. That's because developers only release it when they can make money, right? So they kind of are controlling the market and pushing prices up on the cost of land, not just also reducing the size of the land and blocks, but also the cost of build has gone up dramatically. And I think this is what's really supporting the apartment market right now. The cost of build is really stopping developers building So then you're creating a lack of supply together with a rental crisis and investors bailing. And so even the poorer quality apartments are going up, but they're not going up anywhere near as much as the things that suit the client that would prefer to buy a house, but is going into buy an apartment because they're usually buying in areas where they're super scarce. And I think we should think about this 5% deposit scheme. I think, I don't know what Research House released a report last week. I just remember reading the data. And, I think it was under those caps, I think 90+% of apartments you can buy. And so first home buyers can pretty much buy any apartment under those caps. $1 million in Melbourne, 1.5 in Sydney. You should be able to get, a lot of the apartment stock. And so what that means is that if a lot of, who owns that? Yes, there's investors. So they might capitalize on that. If they could sell their apartment at 1.4 and they, 12 months ago it was worth 1.1 million, they might decide to sell that to then pay off their home loan debt or buy a different investment. So I do think investors will jump on that. But I think a lot of people who will sell the apartments are families and couples that are in those apartments that really need something bigger. And so I think we're going to create a little bit of a bottom-up boom here where, someone who's got that apartment, they really need to upgrade to a house. Maybe they've bought it for $1 million. Now it's worth 1.4. They, had an $800,000 mortgage. Now that mortgage is say $400,000. They've been, it's quite a small mortgage compared to their income because their incomes have gone up. And then they can sell and release $1 million and then they'll re-leverage that into a house. And so I think that the next level of this bottom-up boom is going to be coming into the upgrader market in sort of 6 to 12 months' time. I don't know what you think about that, Pete.
Well, yeah, it does seem to be. And I think I would sort of add to that. As a rule of thumb, I guess like the more, we talk about apartments and units and some people call them flats and so on. But I suppose like the more something feels like a home, that's the type of property that's generally doing well. There are obviously, particularly in the big cities, you get some of these enormous projects where, there's hundreds or thousands of people in the development. And yeah, that's the type of thing where there's no inherent scarcity in the type of stock, almost by definition. And that stuff has really struggled, I guess, in recent times. So yeah, and it feels like you're right. It's people will be upgrading from those sort of sought after boutique developments into something bigger, and that's where the first home buyers and investors will be coming in. And as you said, I think particularly in Melbourne's case, there's a lot of units that are probably transacting below replacement cost, and therefore, just like happened in Brisbane and Perth and Adelaide before, I wouldn't be at all surprised to see a big jump in prices there. It just hasn't happened for such a long time that they're probably overdue. In the Sydney market, units have performed better than Melbourne, maybe, but not so much really over the last 6 or 7 years. So probably a bit of a spike due there as well. We'll see how that one plays out. There's early signs in the figures there from Cotality, but always sort of a little bit skeptical of suburb level figures over short periods of time because it can be a little bit skewed depending on what's transacting, who's buying and who's selling, and so on. So we'll certainly track that as we go through.
The final thing I'd probably throw in with the apartment, if you're looking to invest or buy into it, I think what you want to do is flip out of the mindset of what suits you. Because you're one demographic. You might be a single couple, a couple with one child, child, older kids, younger kids, divorcee, single parent, downsizer, widow. There's so many buyers out there. On top of that is investors, right? And so, which could be, Airbnb investors. There's just people buying for rent. There could be people buying as development. So you kind of want to expand your view and think how many people would really like this property. And particularly if you get into the apartment market, could a downsizer want it? Could a high income couple? And could a family want it? If you get those three buyer pools, I think one's got a lot of cash because they're downsizing, one's not earning a lot of money so they can borrow a lot of money, and one's got a huge emotional need to buy because they want to get security. And so if you can get an apartment, but they have a little bit different. Downsizer wants obviously not many 2 stairs, easy access, parking, but those sort of similar things are for the same. High income couples are a little bit probably got the ability to go up and down stairs, but their preference would be not too many. So just try to overlay that into when you're buying an apartment. I think it's a good little sense check just to protect yourself so you don't buy something that just suits you and not the market.
I could almost feel the first home buyer saying, yeah, that's great, but my budget will only go so far. And I have to just make it go as far as I can, but it is a difficult time to buy, that's for sure, with just so few listings on the market. So now, Chris, you mentioned rising tides lifting all boats. That sort of segues into our second story. Climate change could wipe $500 billion from property values. I guess so. This is a piece that was covered in ABC News Business, but also Ray White did some analysis. So yeah, it sounds like a lot. I suppose $500 billion by 2050, but I suppose the housing market is already worth nearly 12 trillion, and it's rising very rapidly. But yeah, I suppose just to have a look at what has been reported. So the government's been putting out its latest sort of climate assessment reports and so on, which yes, I suppose, a skeptic would say who really knows what's going to happen by the middle of the century. But in any case, 1.5 million people could be impacted by rising sea levels by mid-century. We've also got to think about things like bushfire risk in certain suburbs. So we've seen already insured losses across property have increased to 0.7% of GDP by 2024. I think when it comes to property, this is obviously something we see in Queensland a lot, is that even if you have a property that isn't impacted by things like flooding, if the perception is that you're at risk of flooding, then that can be almost as bad sometimes, because your insurance premia tend to rise. Your potential resale pool as well becomes thinner, because if other people think there's a risk of flooding, and that's why the flood mapping has sometimes been contentious, because you get properties with things like overland flow on the local street, but it might just put off a certain cohort of buyers, and therefore when you're looking to sell, it can be tougher. So just to add to what's been reported sort of at the macro level, Ray White, Nerida Conisbee and the team have done some analysis of some of the suburbs which might be at risk from things like changing climate. So that's flood risk, bushfire risk. And they said, well, at the moment, majority of those suburbs are seeing growth. They took a nice sort of sample, but they did find around 40% of the suburbs they surveyed experienced some price decline. So lower value coastal communities and also some higher value locations, but in particular New South Wales, some of the bushfire prone suburbs have recorded falls. So is that a reflection of climate risk? Well, it could be to a certain degree, but it feels like at this stage, you kind of, that you might be projecting a bit far out. But I suppose the bigger picture for people in transacting in the market is to think about what's happening today, but also just to try and think forward, because yes, it's not necessarily just the risk of you having issues to deal with in terms of flooding or bushfires or catastrophe and things like that, but it's also just a general perception, because if you've got a property, you find it difficult to insure, that means the next person will and the next person will, and therefore it could have a real knock-on impact to either your ability to sell or even just the performance of the property in general.
Look, I'm not going to say I'm a climate expert. We have done a lot of interviews on this on the elephant, and we've had bushfire people through, people who do insurance for climate change. And I think it's one of those things, it's a recency bias. If you think about when there's a flood, people are much more aware of climate change when they've just dealt with it in the last 6 months, but everyone's got short-term memories. If you go back in Sydney 2021 with the bushfires, we have another bushfire season, everyone's going to be concerned about the impacts of climate change, etc. So I think that it's more a case of recency bias, and I do think it'll come back around. And if you're got the belief that it's only going to get worse, not better over time, and you're investing long term, then why not put a few different checks and balances on what you're buying and say, how could this perform in a world under further climate change? Some areas that heat traps, what's the greenery, what's the exposure to bushfire or flooding, or as the climate changes. There's some great, I think it's a climate risk, I'm pretty sure it is, do reports you can download. I think it's $140. I did it on a couple of my properties just out of curiosity, and just understand, that's overlaying big data onto 11 million properties out there, right? Some are very low risk and some are very high risk. And you got to think from an insurer's point of view, while insurance is meant to cover everyone, it doesn't, who's to say that they don't cover everyone, and they start to say, look, it's just too risky. And we've seen that, right? We've seen areas that, it's really hard to get insurance. If you can't get insurance on a property, does a buyer really want to take that risk? Because they could lose everything if that natural disaster happens because they haven't got any insurance. So it is a big thing to think about with property. But I do think it's a recency bias that people forget about here, and they don't think that through. But where it goes and how fast it goes and all that sort of stuff, like you can debate that for years, but ultimately you can still make these changes today the way you invest if you think about it.
Yeah, for sure. So, I mean, the Aussie government released it was a national climate risk assessment. So, the assessment looked at potential impacts of 1.5 degrees warming, 2 degrees, and 3 degrees of warming, projecting property value losses of up to 600 billion by 2050. I mean, I suppose at the end of the day, like, nobody knows. I mean, history shows, of course, the climate will always change. But I mean, putting the projections aside, I mean, we're already, especially in a country like Australia, you already take some of this stuff into account. So we've seen in recent times, for example, flooding in Lismore and places like that, which has just made life hellish for a lot of people. So, as somebody with a family, you think about things like bushfire risk. You have to if you live in Queensland. It's you're thinking, I suppose, in this context, not just about today, but the potential for changing climate down the track. And the Reserve Bank of Australia has also done sort of projections and market research papers and things previously, so showing sort of what percentage of the housing stock may or may not be impacted over the sort of period through to the mid-century. So, yeah, it's an interesting one. It may be difficult to sort of draw any strong correlation with what's happening in the market today, but I guess it's definitely something that people are taking into account. And, of course, as always, if you've got a property, you want to make sure you've got adequate insurance, because that's the kind of worst case scenario. If you are impacted and you're not insured, well, that's that way lies some pretty difficult times.
Yeah, we had a Margaret Cook on The Elephant. I'm not saying The Elephant because I want you to go listen to The Elephant, by the way. I'm not trying to market it, but I'm just sort of referring back to conversations we had on there. And she had the city with a river problem. And I think it's a really interesting concept, right? And so Brisbane, where you are, Pete, you know that market really well. And when there's just been a recent flood, everyone's like, oh, I'm not buying there, not buying there, not buying there. And then all of a sudden, a couple of years later, everyone forgets and everyone's paying premium prices to live in flood zones. And then bang, another flood comes back. You've got cities like Ballina, for example, like, it's got a flooding problem, and parts of Western Sydney have issues. As soon as there's a huge downpour and goes on for a bit, then, all of a sudden there's flooding. Oh, wow, it's happening again. Yeah, exactly. So I think you've just got to be really careful and just think long term where you're buying. Is there any risks that you aren't factoring in? Because often, the climate can repeat itself. Cool. Should we crack on to story 3, Pete?
Yeah, last story this week, and then we'll do your listener Q&A. So third story, first home buyers pounded by soaring prices, covered by Domain and also Macro Business. So Domain finding their prices are soaring at the lower end of the housing market. I mean, that's sort of maps across to what Cotality have also previously found. And I mean, that's their macro analysis. As I was saying at the outset today, we've seen this firsthand in Newcastle, we've seen it in Central Coast, we've seen it in Southeast Queensland, where just even in the past fortnight, we've seen numerous examples of properties just bumping up in prices. In Brisbane, it's probably from that sort of 700 to 800k price point and upwards. We had the one property with 40 offers on it. And all of this is happening before the first home buyer guarantee kicks in proper on 1 October. So, I mean, you could sort of argue that first home buyer's deposit guarantee is potentially self-defeating, because, yes, it helps first home buyers into the market. But if we're seeing affordability is already dwindling in those price points, then, yes, you're sort of giving with one hand, taking away with the other. And I mean, we've seen certainly home ownership rates have dropped in that sub 35 age bracket in recent years, and that's what Domain have found. But yes, the 5% deposit scheme will certainly help more first home buyers into the market. But I guess good for the early adopters, but the people who come thereafter are probably going to be paying more. So first home buyer affordability is actually deteriorating even before this guarantee policy comes into being.
Yeah, I think the argument in that report, it's one of my favorite probably graphs, but it's also one of the most confronting graphs. And I think why I like it is it really explains the real issue that we've created where home ownership rates have fallen dramatically, particularly for the sort of the sub 50-year-olds. And they all sort of end up getting there by 60, but there's a lot of opportunity you've missed if you're not getting there till such late in life. Often, you've got big mortgages coming into retirement, which a lot of data is showing that as well, right? We're going into retirement with a lot more debt than we used to. And I think that's going to be the case where people hold debt to retirement and then they downsize, and they're not just selling an asset tax-free, debt-free. They're selling an asset with debt, and then they're using that gap to cover something, and they're going to have to make a big lifestyle downshift because there's not that much in the kitty. But when you look at it you can go back to the 40s and 50s. That's a long time ago. But even if you went to sort of the 60s and 70s, like you're talking, someone who's say 35, that was maybe close to a 65, 70% ownership rate. That's down to 60. So, 5-10% of them I haven't bought. They'd probably like to buy. And if you go in the next suburb down, it's the 30-year-olds. Well, it's 50% now versus say 60 to 70%. So it's a huge number that I think that's pent up demand in property markets. And, people are used to having kids later, and their needs of housing is probably a little bit later, but their desire to own is still there, no matter where you look at it. Particularly under a rental crisis, people want to own. They want the security. We're not going to this share economy, and people are just going to rent forever. I think it's really hard to do that. And build to rent will solve a bit of that, but even if we come back in 15 years' time, it's going to be maybe a couple 100,000 build to rent, and it's going to be 12, 15 million properties. So, I think that's the desire to own is still there.
Yeah, I think it is. The trend never really goes away. Even with a big immigration policy, we probably do see home ownership rates eroding over time. But it's still the cornerstone of a prosperous retirement, really, is to own a place to live in. So we've got time just for a few listener questions. So first one from Danny. So, hi, guys. I'm wondering your thoughts on our situation. So general advice disclaimer here, of course. My wife and I have $6.5 million worth of property with $5 million in equity, but we don't own a place of residence. So just almost touching on what we were just mentioning before. Our rental income will service an additional $1.5 million of debt. Should we invest in ETFs for diversification? So that's the stock market, effectively, if you're not familiar. Or should we buy a place of residence? We're moving to Perth for a new lifestyle, which means our salaries will be reduced. And my wife wants to retire in 6 years to look after the kids full time. We're 39 and 36. We're just concerned about buying a place of residence at the peak of the market and missing out on stock market gains. Also, the place we want to buy is probably going to cost $2.5 million, which will eat up a lot of our equity. So, this is a crystal ball question, really. So, general advice only, of course, and we don't know the full situation. So, if you're not sure, speak to a financial advisor, etc. Well, what are your options? I suppose, the first one, as you mentioned, is to bite the bullet, buy a place of residence. And I suppose in that sense, you'll be hedged against the Perth market, and you're not effectively short your local housing market. And that's the traditional way to go, of course. You buy a place of residence, you get the capital gains tax discount and the benefits of having your own place to live. I suppose if you're moving to a city and you're not 100% sure how things are going to play out, then you could certainly rent initially and see how you go. I mean, I suppose just from a purely with a sort of financial planner's hat on, you'd probably say, well, yes, you're very sort of hard in real estate, very top heavy in real estate, and less so probably in the stock market. So from that perspective, going into stocks and shares would be a sort of diversification for your portfolio. But as you say, missing out on stock market gains, well, it's hard to say, isn't it? I mean, if you look at so many fund managers, I was reading Bronte Capital this week, and they say, well, how extreme are these valuations globally? They're, pretty much getting towards tech bubble valuations, and yet a lot of people are saying it will keep going. If I only knew the answer to that question, I probably wouldn't be sitting here on the podcast. I'd be glued to the screen on trading the stock market. So it's very hard to predict where the markets go over the next 5 or 10 years. But yeah, how would you go about thinking about that question, Chris? You've got a certain amount of borrowing capacity. How do you know whether to buy a home or whether to sort of stick the money into other investments?
Danny, you need to get some good advice. You're in a really strong position, obviously, 5 million of equity in your mid to late 30s. I agree with Pete, buying it, see how you go in Perth first. I think there's always a good risk management technique if you're in the market to sort of know exactly where you want to buy, particularly with a PPOR and somewhere you're going to live long term as a family. But you've only got 20%, roughly LVR, maybe 25% on your portfolio. Properties is a leveraged investment, right? So yeah, you've got 5 million in there, but you're only getting $6.5 million at growth. It's not really, and then you're paying tax on your rent and, so you're not really getting much from a yield, and your growth on your 5 million is nowhere near as much because it's not very that much levered. So I think you really need to restructure everything and make some real hard calls around what assets to keep, what assets to sell. And you might have to go through a bit of what I call a recycle phase, where you have to shift out of assets into some better structured investments. You also got to be careful here, because if your incomes are going to shift, do they drop now? Do they drop after you move? Can you do remote work? Like, there's a lot going on here for you, Danny, to answer on a podcast, to be honest. But I do think you need to be quite careful, because if you make some shifts now in terms of the way you structure things, you can sort of prepare for that next move. It's very simple to do it from a lending point of view, but a financial advisor who understands structuring and the changes of incomes and, what's a good investment in terms of property, I think it's a really smart move. So thanks for the question, Daddy, but I do think you need to get some good advice here.
As you say, it's a long runway between sort of mid to late 30s and the traditional retirement days. So, yeah, you don't necessarily need to take on big risks, I suppose. I suppose you could say a fairly sort of conservative or defensive position with such a long time horizon would probably go well. So, last question before we wrap up. So, question from FOMO, aptly named. I have a budget of 700K to buy an investment property. Should I A, buy a unit, B, look to buy a house somewhere in regional Australia, or shall I wait until I have a bigger budget in a year or two? Again, it's a very sort of, it's a very much an it depends type of question. So I'm just going to pass it to you, Chris.
No, I like the handball, Pete.
In the AFL theme, I'll flick past that one onto you.
Yeah. Well, look, I'll have a crack at it. I think one of the things we always try to understand first in this question is, why 700? Is that really the number? Like, is that because you got a 20% deposit? Is that because you've set that personal limit? I mean, they have mentioned I can get a bigger budget in a year or two. Is that because you personally think you're going to be more comfortable to spend more? Or have you actually got that budget today? Like, so a lot of times when investors come to us, it's reframing the budget. Because we want to see if there's a way to potentially know what your options are. It's not, so don't put this personal ceiling on yourself, particularly when you're buying investment properties. And so that's the first thing. Whether you buy a unit or a house or a regional, that depends on what unit you're going to buy, or what city you're looking at. That's the first thing. Is it a quad, which we mentioned, or probably a story 1 or 2, whatever it was. A house in the region. Well, what region? Like, so it's you know what I mean? They're very broad sort of segments, and there's pros and cons, right? There's pros and cons to units, particularly with this 5% deposit scheme coming into the market. You might find that's a great little, but then there's a house in the regions might be better because as people can't afford the units in the cities, they are going to shift to regions. We absolutely saw that in COVID. We saw that even pre-COVID. We aren't seeing it as much now because of this return to work battle, which we've spoken about lots on the podcast, but naturally, people need security and stability. It's sort of Maslow hierarchy of needs, right? And so if you think about it'll be naturally people leaving our capital cities to move to the regions. It's just going to be this. Sydney and New South Wales have had that leak for a long problem. A lot of people have gone up north to get the cheaper affordability. That's probably not as much now, but hopefully that helps answer your question, FOMO. I think it's there's pros and cons. And waiting's a hard one. I think it's when sometimes in marketplace momentum's not there, and you can be like, okay, I'm just gonna just going to chill. I'm just going to like not rush this. And I always talk about that, the window of opportunity. I've made like lots of posts on this in years past, and that window doesn't last forever. And often what happens is people jump in once that window's shut, because when there's best buy, it's usually when people are the most concerned and the most willing to chill and sit on their hands. And I think about Melbourne, maybe 2 years ago, 18 months ago. There's times in Sydney, like 2018, 19, great buying. Brisbane, maybe the 2015, 16 time was a good time up there, Pete. No one really wanted to buy up there. But it's usually when people don't want to buy. And unfortunately, that's hard now because the whole country is in an upswing. And even though it's already been in an upswing in some parts for a couple of years.
I'm sure that's the reason for the question. And I'm glad I flicked it onto you, because you answered it much better than I would have done. And I think you're right. Work out what all of your options are first, and then you can make an informed decision. I think if it's, there's a few assumptions embedded in your question there, and maybe there's different ways you can go. If you have a chat to your broker and an advisor, you might just find there's some different ways to think about the question. So thanks for tuning in this week. Come and join us at the Rask Community Forum. That's community.rask.com.au. All free. Great resource there. Come and have a chat and post your questions. Also, send in your listener questions and we'll try and cover those in the weeks ahead. Chris, what's on for the weekend? It's mainly football for me.
Actually go up to Newcastle, see my mum and see a few mates up there. And my sister has a baby. Well, I'm waiting for a text message at any point. So it's happening, but not due for a couple of weeks. But trying to get in some grandparent help before we've got competition in the family. This little new baby is going to be the center of attention, and we're going to be like, hey, remember us? We need some help too. But go up to Newcastle, see my mum. What about you?
Very nice. Enjoy that. I had split loyalties this week because I had Mo Salah as captain of my fantasy league team, and he scored right in the last minute, 95th minute, to see you guys through in the Premier League. So, well done. Liverpool's unbeaten record continues apace. So
the most luckiest start to the Premier League season. I'm not going to talk about it too much because I don't want to jinx it, but we've been extremely lucky to be winning 4 games. So let's see how the season goes. It's a long time. It's the end of the AFL season, but it's really only the start of the Premier League. So I won't say too much over here.
Be lucky. Right, have a great weekend, Chris, and enjoy everyone, and look forward to seeing you next time.
Talk soon. Bye.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.